The dark game no one taught you most. People believe that wealth is built by buying things that rise in value. They invest in stocks hoping the price will go up. They buy houses expecting the value to appreciate. They work jobs to save money, assuming the future will reward their patience. But there's a silent group that profits when everything crashes. They don't wait for growth. They don't follow the crowd. They win when others lose. This strategy is not taught in schools. It's rarely discussed in mainstream media, but it moves billions, sometimes trillions. It's called short selling, and it's how a few people have made fortunes during economic disasters. They didn't invent new products. They didn't run companies. They simply knew when things were about to fall apart and bet on the fall. Some call it betting against hope. Others call it smart risk management. But those who know how it works just call it opportunity. It's the financial system's hidden lever. When used right, it can build generational wealth. When misused, it destroys lives. That's why it's feared, misunderstood, and often labeled dark magic. But once you understand it, you'll never look at the market the same way again. Because the moment you realize that profit does not need things to rise, you stop thinking like a consumer. You stop acting like prey, and you start seeing the cracks before they collapse. Let's break it down. Let's start with the basics. Let's talk about what short selling really is. Let's talk about how it works, and why the richest investors in history used it to beat the system. This is the passive path. What is short selling? Short selling is the idea of making money when prices go down. You don't buy low and sell high, you sell first, then buy back later at a lower price. The difference is your profit. That's the core. But here's how it actually plays out. Let's say you borrow a stock from someone. That stock is worth $100 today. You sell it immediately for $100. You now have the cash. Then the stock drops to $60. You buy it back, return the stock to the person you borrowed it from. You keep the $40 difference. That's short selling. You profit when something falls. It sounds backward because most people are taught to believe in growth. But growth isn't guaranteed. Decline happens all the time, and short sellers are ready for it. They see bubbles before they burst. They see hype before it fades. They don't just bet on success. They bet on failure. And when they're right, they win big. This isn't just theory. Some of the most famous investors built fortunes this way. But before we talk about them, let's simplify the concept even further. Imagine your neighbor owns a rare collectible. You know the value is about to drop. You borrow it from him, promising to return it later. You sell it at the current high price, wait for the price to crash. Then buy the same collectible back for cheap. Return it, and keep the profit. You didn't own the item. You didn't need to create anything. You just timed it right. That's all short selling is. It's spotting overvalued things, waiting for gravity, and getting in before the fall. But this isn't a trick for beginners. It carries real risk. Still, when used properly, it's a powerful tool. Not just for the rich, but for anyone who understands how money flows when fear rises. To use it well, you need to study the masters, because they've done it when it mattered most. And their stories will teach you more than any textbook ever could. The three masters of shorting: Jesse Livermore, Michael Burry, George Soros. Three names that made history by betting against the market. They didn't play it safe, they played it smart. And when the system cracked, they were ready. Jesse Livermore was one of the earliest short sellers to shake the entire US economy. In 1929, while the country was booming, he saw something others ignored. Too much credit, too much hype, too much greed. He shorted the stock market just before the Great Depression. While banks collapsed and investors panicked, Livermore walked away with over $100 million. Adjusted for inflation, that's billions today. He didn't build a company. He read the signs and made his move. Then there's Michael Burry. He saw the US housing market was full of bad loans in the early 2000s. No one believed him. He studied mortgage data for hours every day. He found cracks. He shorted the housing market using credit default swaps. In 2008, when everything collapsed, he made hundreds of millions. His clients made even more. While average families lost their homes, he made money betting they would. Not because he wanted people to fail, but because the system was built on a lie. And then came George Soros. In 1992, he saw that the British pound was overvalued. The United Kingdom was struggling economically. Germany was gaining strength. Soros placed a $10 billion bet against the pound. In a single night, he made $1 billion. The Bank of England had to give up. They couldn't fight the market forces he exposed. And in 1997, he did it again, this time in Southeast Asia. His moves caused entire currencies to crash, nations to fall into financial crisis. People called him dangerous, but all he did was see the inevitable and act first. These men didn't rely on optimism. They relied on data. They saw when things were too good to be true, and they made their move before anyone else did. That's what short selling is really about. It's not about hoping things fail, it's about recognizing when things are already failing beneath the surface, and using that insight before the collapse becomes obvious. Their stories aren't just history lessons, they're blueprints. Why it's called dark magic. Most investors want prices to go up. They buy stocks, homes, or crypto, hoping values will rise. They cheer for bull markets. They fear crashes. But short sellers do the opposite. They look for cracks. They wait for hype to fade. They profit when everything sinks. That's why many people call short selling dark magic. It goes against human instinct. It feels wrong to bet on failure. But in markets, failure is part of the game. Short sellers don't create collapse. They reveal it. When something is inflated far beyond its real value, it's already unstable. Short sellers just act before the fall happens. This flips the script. In a world chasing growth, they bet on decline. When the crowd is greedy, they become cautious. When everyone is buying, they look for exits. This mindset makes them dangerous to institutions because they don't play along. They question everything. They attack illusions, and that makes them enemies of comfort. Governments fear them. Companies hate them because when a short seller targets something, panic spreads fast. They don't need to crash a system. They just need to whisper. And if the fundamentals are weak, the structure collapses on its own. It's a domino effect. Investors sell out of fear. Prices drop, more panic follows, and the short sellers cash out at the bottom. This isn't manipulation when the weakness is real, it's exposure. But that's why it feels like magic, because most people never saw it coming, and those who did were too scared to act. Short selling doesn't just require knowledge, it requires courage, to stand alone, to go against the crowd, to bet on decline when the world screams growth. That's why the few who master it are called ruthless. But in truth, they're just early to spot the lie, early to act, and early to profit from it. They don't create storms, they sail through them, while everyone else drowns. How short selling works. You don't need to own something to profit from its fall. That's the core idea behind short selling. But here's how it actually plays out in real markets. You borrow an asset, it could be a stock, a currency, a futures contract. You sell it right away at the current price. You now hold cash, then you wait. If the price drops, you buy the same asset back at the lower price. You return it to the lender and keep the difference as profit. This works because of market mechanics. Assets are often held by brokers or exchanges. When you own a stock, it's usually stored in the brokerage's name. They can lend it out to someone else, even while showing it in your account. That's how short sellers get access. They borrow those shares, sell them, then buy them back later. All within the rules. But what causes the price to fall? The initial selling pressure does part of the work. Then fear kicks in. Rumors spread, weak investors panic, and sell too. The chain reaction begins, and the price tumbles. Short sellers time this cycle. They sell high, let the panic play out, then buy low, return what they borrowed, and lock in gains. It's a clean system if done right, but there's a catch. Brokers charge interest on borrowed assets. The longer you hold the short position, the more it costs. If the price doesn't drop fast enough, you bleed money slowly. Also, you need margin. That means collateral. Brokers won't let you short unless you have enough money locked as security. If the trade moves against you, they'll take your funds to cover the loss. And if the price rises instead of falling, your losses are unlimited. That's the danger. With normal investing, you can only lose what you put in. With short selling, losses can keep growing as prices rise. That's why it's a tool, not a strategy. You use it in the right moment, not all the time. You don't short a strong company, you short hype, you short bubbles, you short fraud. And you do it with clear risk control. Because without limits, this game turns brutal. But when you understand how short selling works, you start to see things differently. You stop chasing trends, you start watching cracks. And you realize the biggest profits aren't made in booms, they're made in crashes. The risks most don't talk about short selling looks sharp on paper, but in practice, it can get ugly fast. When you buy a stock, the worst case loss is zero. The company crashes. You lose what you invested. End of story. But with short selling, there's no ceiling on your losses. You sell a stock at $100. It doesn't fall, it climbs. Now it's at $150. You still have to buy it back. That's a $50 loss per share, and it could keep climbing. To 200, to 500, like GameStop. That's the risk. It's not just about being wrong, it's about being squeezed. A short squeeze happens when too many people bet against a stock. If the price starts rising, they all rush to buy it back. That drives the price even higher. Panic spreads, losses multiply. Some traders go bankrupt in hours. That's why brokers require margin. They want security. They also charge interest on the borrowed shares. Even if the price stays the same, you lose money slowly from borrowing costs. And if your position goes deep into loss, your broker can liquidate you. They'll close your trade without asking. To protect themselves, not you. There's also headline risk, rumors, unexpected news. A good earnings report, a sudden buyout, all can flip a losing company into a rising star, at least for a moment. And that moment is enough to burn your short. That's why short selling isn't casual. It's not something you do because a price looks high. You need solid research, clear entry and exit, strict stop-loss limits. Without that, it becomes gambling. And gambling in a system built for volatility is suicide. Still, the risks don't mean you should avoid it forever. They mean you need to respect it. Treat short selling like a knife. It cuts fast and deep, but in skilled hands, it's a precision tool. Used right, it can protect your wealth. It can multiply it. It can hedge against disaster. And sometimes, it can be your best move in a bad market. How to spot a short opportunity. Short selling works best when the asset is overpriced and hollow inside. Two signals matter most. The price must be high, and the fundamentals must be weak. You're looking for shiny garbage. Assets that look valuable, but have no strength underneath. This happens more often than people think. It happened with the Mississippi Company in the 1700s. They promised gold mining in America. Their stock soared across France, but there was no gold, just swamps and fake reports. When reality hit, the stock collapsed. Investors lost everything. A modern version is Luckin Coffee. They look like the next Starbucks in China. Fast growth, big expansion, perfect story. But researchers noticed something odd. The stores were always empty. Too many receipts didn't match the reported sales. So a short-selling firm launched an investigation. They hired students to count customers. They collected receipts and crunched the numbers. Turned out Luckin had faked over $300 million in revenue. The stock crashed, and short sellers made a fortune. The lesson is simple: don't trust hype, trust facts. Look at how the business really performs. Not what they claim. Check insider actions. If executives are dumping shares, that's a red flag. If customer traffic is dropping, that's a clue. If the product doesn't sell in the real world, it won't last on paper. You're hunting for cracks before they go public. That's the edge. Most people react to news. Short sellers look ahead. They find the rot early. They strike before the collapse. That's how they win. And that's how you learn to think differently, by questioning the surface and digging where others don't bother. How hedge funds investigate targets. Big short sellers don't guess. They investigate, they gather evidence like detectives, and they often find what others miss. One method is on-the-ground research. They send people to observe, to count, to record. In the Luckin Coffee case, investigators didn't rely on financial statements. They sent over 1,000 college students to monitor store traffic. Each student stood outside a location and filmed customers. They tracked how many people entered, how many left with coffee. They did this for weeks, at dozens of stores. Then they collected receipts left behind by customers. They used the data to estimate actual sales and compared it to the official numbers. The gap was massive. Over 80% of the reported revenue didn't exist. That wasn't speculation. It was proof. And it brought the company down. This is called channel checking. It's simple but powerful. You watch the business in the real world. How many trucks leave the warehouse? How full the parking lots are? How many customers return items? This is what smart short sellers do. They don't believe headlines. They check reality. They also monitor insider activity. If company executives are selling large portions of their own shares, that's a red flag. They know something. And they want out. Short sellers track these moves. They analyze regulatory filings. They compare sales patterns. They interview former employees. They reverse engineer the business from the ground up. It's not glamorous. It's work. But it exposes lies faster than any chart. And when the truth comes out, it hits hard. The market crashes, the short position pays off, and the world finally sees what was already broken. This isn't luck, it's strategy, and it works. The George Soros playbook in 1992, The British pound was in trouble. The economy was weak, debt was rising, Germany was strong and raising interest rates, but the UK couldn't keep up. To stay in a European agreement, they had to hold the pound at a fixed value, even though it didn't reflect reality. George Soros saw the mismatch. He borrowed billions of pounds from banks, then sold them all. At the same time, he bought the German mark. The logic was simple. The UK would have to devalue the pound eventually. When they did, he could buy it back for less and pocket the difference. The government tried to fight back. They raised interest rates. They burned through foreign reserves. But it didn't work. Soros kept selling. So did other traders. The pressure became too much. The UK gave up. They let the pound fall. Soros made over $1 billion in a single trade. That's why they called him the man who broke the Bank of England. But he wasn't done. In 1997, he saw similar weaknesses in Southeast Asia. Thailand had rising debt and a massive trade deficit. Their central bank had limited reserves. Soros bet against the Thai baht. He borrowed it, sold it, and waited. The Thai government tried to defend the currency, but they couldn't. It collapsed. Then other Asian currencies followed: Malaysia, Indonesia, South Korea. It triggered a regional financial crisis. Soros didn't cause the weakness. He saw it early. He acted faster, and he got out before the damage spread. This is the playbook. Look for overvalued currencies with weak fundamentals. Check the country's reserves, debt levels, inflation trends, interest rate policies. If they don't align, there's a short opportunity. This works because currencies reflect confidence. When confidence breaks, collapse happens fast, and those who move early win. That's the Soros method. It's not magic, it's math and timing. Naked short selling explained. There's a more aggressive form of short selling. It's called naked short selling. You sell something you haven't even borrowed yet. No shares in hand, no currency in your account, just the belief that the price will fall and that you can buy it later for less. It's high risk, but it works in certain markets like Forex or futures. Here's how it looks. You sell a currency pair on a trading platform. You don't actually hold the currency, but the broker lets the trade go through. You're betting the price will drop. If it does, you close the trade, buy the currency at the lower price, and the platform settles the difference. You never owned anything, but you still made money on the move. That's a naked short. It's fast, cheap, and dangerous, because if the price moves against you, you have no buffer, no asset to cover losses, just pure exposure. In most stock markets, this is banned, especially after the 2008 crisis. Firms were shorting financial stocks without owning them. It created chaos. So regulators stepped in, but in Forex, it still exists, because Forex is decentralized. It runs 24 hours a day, and there's always a buyer and seller. If you trade Forex, you've likely done naked shorts without realizing it. Every time you open a sell position without holding the currency, that's it. The key is knowing the risk. Set tight stop losses. Manage your margin and only trade what you understand. Naked short selling isn't for beginners, but in the hands of a skilled trader, it's a fast way to bet against weak economies. And when timed right, it delivers massive returns. This is how currency traders operate. They watch central bank moves, inflation trends, trade balances, and when things look unsustainable, they strike. No borrowing, no delay, just execution and profit. Should you try it? Short selling is not for everyone. It's not simple, it's not safe, but it's real, and it works. If you want to try it, start with knowledge. Understand how brokers work, how borrowing works, how margin works. Use demo accounts before risking real money. Learn with fake trades. Watch how prices move. Track your results, then move to small positions. Don't bet your savings. Bet your curiosity. Focus on Forex first. It's more accessible. It runs 24/7. And the platforms allow shorting without borrowing. Study economic indicators, interest rates, inflation, trade deficits, currency reserves. That's where the edge begins. Look for weak countries with strong neighbors, just like Soros did. When one central bank is printing money and another is tightening, you have imbalance. That imbalance creates opportunity, but always protect the downside. Set stop losses. Never over-leverage. One bad move can wipe you out. The goal isn't to get rich overnight. The goal is to understand how the system really works and position yourself smartly. Over time, you'll get better. You'll start seeing patterns and you'll know when to strike. Not every short will succeed, but when it does, The profits are quick, and the risk is managed. Short selling isn't evil. It's just another side of the trade. While others chase hope, you watch reality. While others buy the peak, you prepare for the fall. It's a mindset. And once you learn it, you see the market in a new way, a more honest way. One where both rise and fall can build wealth. And that's how you take control of the game. The smart way, the prepared way, the passive path.